All right, folks. It is 11:01, and we have about 180 people joining us today. We want to welcome everybody and just take a moment to kind of give you the lay of the land here. So today is going to be Department of Revenue's pass-through entity tax webinar, and this will give you all the ins and outs as far as property or pass-through entity going on today. I'm kind of the host today. My name is Jason Sleed, and we have two of our presenters. David Marion is our Business and Income Tax Bureau Chief, and he will be presenting the information today. He's the one who actually has the slideshow that's up today that you see in the background. We also have Rachel Milne. She is our income tax specialist. She will be monitoring any of your questions that show up in the Q&A. Now, as we're speaking about the Q&A, let me tell you a little bit about that. So if you look at the bottom rail of your screen, you have in the Zoom client, there's bottom rail of the screen, there's a Q&A. That is your place to ask questions of the panelists. So you can ask it about maybe the slides that are going on as you see them, or questions that might arise. And Rachel's going to do a good job of getting those answers or elevating it to David. And we're just going to try to answer as many questions as we can. There's 199 people in here in the webinar right now. And so I hope we don't get overwhelmed with questions, but we'll see how things go. If we don't get all the questions answered, we will address them later and have them be on our website. So we really encourage you to go to the bottom Q&A and type your questions there, and we will get to those questions as we have time and as it's pertinent to our presentation today. If it gets too specific in nature, we probably can't answer those. For the general public, we may have to have somebody reach out, but in the grand scale of things, we'd like to have everything addressed here, and that way one person's question can help out everybody else in the webinar today. So without further ado, we don't have any other questions. We will be recording this. It will be on our website. And you'll also notice on our website that we do have more webinars coming out. So you want to make sure that you get lined out for those, and it will be the same setup as these. So if you like the format of this, you can get involved with more of it. And we sure really like to have this participation because it allows us to talk to our customers directly. So it's kind of nice to be the kind of horse's mouth. All right, David, how are things?
Very good, thank you. Thank you, Jason.
How was your Thanksgiving?
It was good. Not too much tricky.
I got to show off some of my Clue skills to some of my nieces. I taught them that their uncle was pretty savvy the game of Clue. So I'm coming off a good weekend. So
All right. Thank you, Jason. Yes. So today I'm going to present the Montana Pass-Through Entity Tax that we call PTET. That's its nickname. And its subtitle: The Tax Pass-Through Entities Want to Pay, and we'll learn all about this. Why do they want to pay that tax, elect to pay that tax, and how to pay it, and the effect it has for pass-through entity owners. So I hope everyone can see my presentation here.
Yep, we're on
it. Cool. What is PTET? So PTET, the pass-through entity tax, is an elective state income tax, and it's paid by pass-through entities. So it's an election. That's important. If the pass-through entity representative don't want to pay that tax, they don't have to. So why would a pass-through entity elect to pay a tax, you ask me? Well, it all comes down to the deduction for state income tax deduction on individual income tax return under Internal Revenue Code 164 and the Tax Cuts and Jobs Act that limit that deduction on owners' returns to $10,000. So in order to allow business owners or partnership and S corporation owners to take a deductions that's beyond $10,000, IRS Notice 2020-75 allows pass-through entities to pay a state income tax that would be taken above the line, and therefore, in addition to the $10,000 of state income tax deduction that can be taken on Schedule A for federal tax purposes. And therefore, since it's an additional deduction, owners can reduce their federal tax bill. So that's the whole point of the pass-through entity tax as it was passed by the legislature in 2023. PTET, however, is neutral for state tax purposes. And what does that mean? It means that any pass-through entity tax that is paid by the pass-through entity has to be, that is not paid or accrued, but deducted anyway, must be added back on the Montana returns. And the owners of the pass-through entity receive a refundable credit based on their distributed share of PTET liability. And that is an information that will be included on their Montana K-1 starting in 2023. So that sounds great. What do I need to do if I'm a pass-through entity? If you are a pass-through entity, you need to identify a pass-through entity representative that will make the election to have the pass-through entity pay PTET or not. That election is done on Form PTE. So this is the same Form PTE, although it has been remodeled to include the PTET. So the same form that you used to use to pay to report partnership or S corporation income will be used to make the election for PTET. And when does this election needs to be made? Well, it's by the extended due date of the return. So since PTET can be elected for tax year 2023, that election can be made to until like September 15, 2024. One important piece of information here is that there's not going to be any exception to that extended due date. So any election made after September 15 will be denied and disregarded. So it's important to have this in mind. Now, what is the taxable income for PTET? The taxable income is the total distributive share of Montana source income allocable to affected owners. And we're going to go over what that means, especially Montana source income and affected owners. Let's start with affected owners. Affected owners for PTET are individuals, estate and trust, PTEs, including pass-through publicly traded partnerships, so PTEs meaning partnerships and S corporations, and disregarded entities owned by an individual, estate, or trust. So those are the owners that are going to be affected by the PTET election. Owners not affected by the PTET elections are corporations, tax-exempt entities, disregarded entities owned by a corporation or partnership, and disregarded entities that do not disclose their owner. They are going to be deemed to be owned by a corporation or a partnership. So owners not affected by PTET means that their distributed share of Montana source income is not going to be included in the taxable income for PTET purposes. So there's a bifurcation between owners affected and owners not affected. And that bifurcation is taken into account on the return. Montana source income. By default, what we mean by Montana source income on the pass-through entity form is the income that is apportioned or allocated to Montana using the compact. So, apportionment factor or allocation rules in 15.1.601. That's the default way to determine Montana source income. However, in the PTET statute, there is also a resident election that can be made by the pass-through entity representative. And if that resident election is made, the Montana source income allocable to resident owner increases to their distributive share of everywhere income. So in this case, an affected owner who would be a resident individual, if that resident individual is an owner in a pass-through entity that has multi-state activity, if the pass-through entity makes that election, then we are going to increase their distributive share to their everywhere income. So because all their income is actually taxed in Montana. It sounds a little complicated. We're going to go over an example here, and that's going to make it easier to understand, and with regard to its purpose mainly. So let's take a look at what are the affected resident owners. So those are resident individuals, resident estate and trust, and disregarded entities owned by a resident individual, estate, or trust. So those are the affected owners that can benefit, so to speak, from paying more taxes in Montana and reduce their federal tax bill. So resident individuals, resident estates and trust, and disregarded entity owned by a resident individual, estate, or trust. When does this election, resident election can be made? So it's made on the pass-through entity return, and it is mostly when the pass-through entity has multi-state tax activities. If the pass-through entity doesn't have multi-state tax activities, it's all doing activities in Montana, 100% owned by resident or non-resident, by the way, then there's really no need to make that resident election. Another set of circumstances when this election should be made is if a pass-through entity doesn't have Montana activities at all and wants to have their resident owner benefit from the pass-through entity tax. In this case, they would have to file a Form PT in Montana and elect to pay the pass-through entity tax, elect the resident PTET, and in this case, all the everywhere income from their K1 would be subject to PTET, and they would be able to benefit from that deduction. Beware that this election may not be recommended for S corporations, mostly because in some circumstances it may create a different class of stock and not compatible with this the S election. So let's take a look at an example here, and I think that will make things a little clearer for everyone. If we assume an apportionment factor of 20% under the compact, so we are here in the situation of a pass-through entity that has multi-state tax activities. And this pass-through entity has different types of owners. So there's a first set of owners that is not affected by PTET. Remember, those are like corporation or tax-exempt entities, for example. Their total everywhere income is $100,000. None of these $100,000 will be included in the PTET taxable income because the owners are not affected by pass-through entity tax. And then there's a different set of owners affected by PTET, and For those ones, the Montana source income will be included in the pass-through entity tax taxable income. So this subset, this category has two subsets, residents and non-residents. So resident affected by PTET receive a total everywhere income of $20,000. Now, without the resident election, the amount of taxable income that relates to those $20,000 is $4,000 because we have a 20% apportionment factor. With the resident election, that amount increases to $20,000, and therefore the pass-through entity will pay more taxes and will be able to deduct more on their federal tax return. Non-resident owners affected by PTET receive a total everywhere income of $50,000, and of those $50,000, $10,000 is included in the pass-through entity tax taxable income. That amount is not affected by the resident elections because those affected owners are not resident. So we see here the difference between making the election and not making the election. Without a resident election, that pass-through entity would recognize $14,000 of taxable income for PTET. And with the election, it would recognize $30,000 of taxable income for PTET. And again, because this is a tax that pass-through entity want to pay in order to get a larger federal deduction, that election is worth considering. And I hope that this example really clarifies the mechanics of the two elections.
Hey, David.
Yes.
We have a question. Will you be addressing how to determine the amount of estimated PTET for 2024, any safe harbor provisions, and how to determine the amount of penalty for not making proper estimated PTET payments?
Sure. So we are going to, yes, I have a section on that just right after.
Great. Thank you.
The PTET rate for 2023 is the highest marginal tax rate, so it's 6.75%. Nothing really much to talk about this. Let's talk about money then, and that's when we're going to talk about how to pay for PTET and estimated payments, and especially for 2023. So PTET can be paid in three different ways: estimated tax, including prior year carryovers, flow-through payments, and with the return. And be aware that those three methods of payment may have different results with regard to how much you can deduct on the federal return, because most pass-through entities are on cash basis. So estimated tax required. So once a pass-through entity elects PTET based on the statute, it should have paid estimated tax. With regard to 2023, though, because there was no PTET in prior years, the department took the stand that no interest on underpayment will be due for the 2023 tax year. Essentially, it's as if everyone was benefiting from the safe harbor for underpayment for estimated tax. So there's no underpayment at all. So what does that mean? That means that pass-through entities can pay the estimated tax in 2023 in order to generate a deduction for federal income tax purposes, and that the date when they pay this estimated tax doesn't really matter as long as it is paid in 2023. And so it can even be paid at the end of December in a way, and that would still count as a payment of PTED in 2023 with a deduction on the federal 2023 return. I hope that answers the question. On Form PTE, how does this payment will be accounted for? If the election is made, any amount paid in 2023 will be accounted for as a PTED payment. So if a pass-through entity already made tentative payment for pass-through withholding, for example, those payments can be requalified when they file the return as a PTED payment if they make an election. And there's really nothing they have to do about this. All they have to do is make the election. Then any amount paid by a pass-through entity will be, after PTED, will be used to offset any composite tax liability. And third, the pass-through withholding. So the form has been redesigned in order to accommodate that cascade of payment, and that gives a lot of fluidity in the system, so that if you don't know if you're going to elect PTED, but you know that regardless, if you didn't have to pay PTED, you would have to pay composite tax or pass-through withholding, you just make payments, and that characterization of the payment will happen on the return when the PTED election is made. If you are a Montana business that usually didn't have to pay anything, then you should probably start thinking about how to make payments at the entity level before the end of the year. Three kinds of flow-through payments. So pass-through entity tax, pass-through entity return is getting a little bit more complicated now. There used to be only two kinds of flow-through payments that were identified on the return: the mineral royalty withholding and the pass-through withholding. And now there's this third one, which is the PTED credit. So those three flow-through payments will be also applied against PTED and other liabilities in a certain order based on the elections that are made. So that's a little complex. And that's the reason why we added this year a new schedule for flow-through payments, and allocating those flow-through payments to the three types of liabilities that you can have on the Form PTE. So in a little bit more detail here, mineral royalty withholding and pass-through withholding are considered PTED payments up to the amount allocated to each owner. So first, you're going to allocate mineral royalty withholding and pass-through withholding to each owners based on their percentage of income or loss, and then based on whether they are you elect PTED, and if they are an affected owner or not, then those payments are going to apply against the PTED owned by the pass-through entity. Here we're talking about a pass-through entity receiving pass-through withholding from a lower tier, for example. However, you can receive mineral royalty withholding without having a lower tier, is just because the pass-through entity owns mineral royalty rights. Now, PTED credit, so mineral royalty withholding and pass-through withholding, once they are characterized as PTED, then they can generate a new deduction because it's a payment. And the timing of this payment is kind of tricky. It's really the preparers will have to try to find out when it happened, because obviously this recharacterization will happen in 2024. So if you don't know that when those payments were made, it's likely that this will become a deduction in 2024 only. PTED credit is also considered a PTED payment in full. However, because it's already been deducted by the lower tier, it's not a new deduction for federal tax purposes because it's already been deducted. Now, technically, that means that you can be in a situation when you have overpayments of PTET. I mean, in a way, this is probably going to happen more often than not, just because this is how estimated tax works, and also because you don't necessarily know how much flow-through payment you're going to receive. So PTET overpayment will be used against the other taxes that you must recognize or calculate on Form PTE, and the excess will be refunded to the PTE, or you can choose to carry it over.
Hey, David, while you're taking a drink, Rachel had asked that we answer a question live, and the question is: can Montana mineral withholding for oil and gas be deducted as a PTET for the entity?
Yes. So as if I come back here, the mineral royalty withholding it needs to be first allocated among the owners, and if you elect, the portion that is allocated to the affected owners will be used to pay for PTET and becomes a PTET payment essentially. Yeah? And that payment will be reflected on the flow-through payment schedule, and I have examples of this a little later. We'll see that how it works.
Cool. There's also another one that says, please elaborate on the timing of the deduction, as that is very important, especially cash versus accrual.
Yes. So the timing, the notice 2020-75 seem to assume that everything is on cash basis, but it's not very clear, and the IRS never really confirmed whether or not that's how they were going to treat it. So we don't really have a position on this, really. I mean, it's essentially a federal tax issue, and the timing of the I mean, the deduction, the amount of deduction depends on the timing of the payment, mostly because most pass-through entities are on cash basis. So if you wait to make a payment of the PTET you assess for 2023, if you wait to make that payment in 2024, that deduction is not going to be on the 2023 return, it's going to be on the 2024 return. That is why it's important for most pass-through entities to contemplate making estimated payments before the end of the year. All right. So overpayment, I think we did that. So let's also we're going to have examples, and they will be available also on publication 4, PTET guide, which Rachel mentioned already, and I think we strongly believe that this is going to be available by the end of this week. So if we look at examples. Here, this is a simple example of a PTE electing PTET and resident PTET. You have an ordinary business income of $100,000 and an apportionment factor of 60%. And that partnership is receiving mineral royalty withholding on a Form 1099 MISC. So here are the flow-through payment schedule, which has two parts. What it looks like. So first, you're going to identify the document and the entity that is paying this flow-through payment. So here we have ABC LLC, which has a fake FEIN, of course, that issued a 1099 with $2,000 of mineral royalty withholding. Okay, and this partnership is very simple. It only has, I think, 2 owners, and they are one is a non-resident and one is resident. So 100% of the owners or the profit and loss is going to affected owners, and therefore 100% of those $2,000 is going to be used to pay for PTET. And that, if it had been, and we'll see another example later, but if we've had non-affected owners, then the question would be, are they electing to pay composite tax, or are they subject to pass-through withholding? And then the allocation of those $2,000 would have been different, of course. So the effect here for the first owner, who is a non-resident, is that we have $30,000, sorry, 60% of 50,000, $30,000 of taxable income, and PTET is $2,025. So that's because the non-resident cannot benefit from the resident election. Now, for the other owner who is a resident, the tax is not calculated based out of apportionment amount or apportion amount, which is $30,000. It's calculated out of the $50,000, which is the everywhere income, and the tax increases to $3,375. Now, on page 2 of Form PTE, which has also been redesigned, as I mentioned, to accommodate the cascade of payments. In this example, hasn't been any estimated payments, so all the payments are going to be 2024 payments. Therefore, for federal tax purposes, you're going to have a deduction only on the 2024 return. And the calculation is relatively simple. We have $5,400 of pass-through entity tax, $2,000 of mineral royalty withholding that comes against it, and the entity has to pay $3,400 with the return in this case because they didn't make any estimated payments. If we look at the second example, we have an S Corp here not electing to pay PTET. We wanted to show an example for an entity not making the election because, especially with regard to S corporation, this is going to happen. Bear in mind that also, if you are a lower tier and you don't really have, especially individual owners or affected owners, you don't have to make that election. You can just let the income flow through to an upper tier that can make the decision whether or not their owners would benefit from this election or not. So in this case, however, we have an S corporation and they receive a flow-through payment, PTET credit, because a lower tier made that election, but because that PTE is an S corp, they decided not to make that election for their shareholders, and we'll see how it works. So we've got $500,000 of everywhere income, and that they have a 60% apportionment factor also, and they have flow-through income. So they deduct their flow-through income and then add it up. In this case, it's all 100% Montana, so it's simple. And here is how the PTET credit will work. The PTET credit will be included on column C of the pass-through entity tax received. And in this case, because the S Corp doesn't make any election and there's no composite tax election, all the entire 5,000 is allocated, is distributed to owners. So based on their percentage of profit and loss, and therefore there's not a creation of a second class of stock. So here in this case, we have $2,500 for the first resident shareholder, and $2,500 for the second shareholder. The second shareholder, being a non-resident, is also subject to pass-through withholding. We're assuming there's no waiver in place here. So in this case, and that's kind of a something to remember, especially when you use some software. It might not be obvious at first, but the pass-through withholding is not going to be necessarily the full amount if there's PTET, because it's going to be reduced by the amount of PTET that is already paid. So we didn't want to have non-resident owners that are overpaying, and therefore we reduce the amount of pass-through withholding by the amount of PTET credit already that shows on their K1.
Hey, David, just so you know, as you're presenting your screen, you have a badge notification from Zoom that's saying, "Hey, you're sharing this." If you want to hide that, good, because sometimes it covers up the form. And
Okay.
it was anything dicey yet, but this just might help people.
All right, thanks.
Yeah,
I wasn't aware that you could see this.
I
Okay.
figured you were on a roll. I get it. I understand.
All right, so that's the K1. I know it was hiding a little bit that line. So that's the pass-through entity withheld, and then obviously page 2 of the form will show the amount owed only, because there's no election here. All the credit has been distributed to the owners, that they can claim that as a refundable credit on their returns. So that's all that you can see on page 2. Now let's see a more complex example, and hopefully everything will come together here. We've got a partnership here with $100,000 of everywhere income. Again, there's flow through income and a 60% apportionment factor. In this case, the flow through income is not entirely Montana source. So a little bit more complicated. And then we've got, at least on the front here, 8 owners. I'm not sure we show the 8 owners. I think we show only those that matter. And we have a resident owner and a non-resident owner. Okay. So here is the flow through payment schedule of a more complicated tax situation for the partnership. The partnership is receiving the 3 types of flow-through payment: mineral royalty withholding, pass-through withholding, and pass-through entity tax received. And you have owners in all 3 categories: pass-through affected owners affected by the pass-through entity tax, owners that are not affected but elect to pay composite, and other owners. So here we can see that each type of payments, flow-through payment, is allocated against the aggregate income of the owners in each category based on their aggregate amount of percentage of profit and loss. So 72% of the $100 of mineral royalties go against the PTET, that's $72. 7% of that 100 goes against the composite, that's $7. And then the remainder 21 is going against is allocated to owners who may or may not be subject to pass-through withholding. There's also a case on line 3 of mineral royalty withholding passed to owners of $12. That amount is allocated to the owner because that owner doesn't have to pay any tax. So if you are in the situation where an owner doesn't have to pay any tax, neither PTET, nor composite tax, no pass-through withholding, then their allocable share of mineral royalty has to be passed to that owner so that they can claim it on their individual income tax return. Same for column B, which is the pass-through withholding received. That's the same mechanism. And for pass-through entity tax, however, it's a little bit more tricky. The pass-through entity tax credit can be passed only to affected owners. So it's going to be entirely applied against affected, the pass-through entity tax owed by affected owners. If that partnership were not to elect, then it would be evenly distributed between column B and C. Evenly distributed based on the share of profit and loss that shows on column B and C. But when there's an election, everything is allocated to column A. Let's see how it shows on how this is reflected on the K1s. So here is one of the K1. It's a resident owner. There's a resident election, so that is the tax paid for that resident owner based on the everywhere income. You can see here we wanted to show how it's going to show on the Montana K1 that there's an adjustment here that shows up on part 7. This adjustment is reflects the add back of the deduction taken on the federal return. That deduction, the amount of add back here doesn't necessarily match the amount of PTET paid, because remember, it's a matter of timing. So maybe sometimes only part of the amount assessed and passed will be actually deductible in that year. And that's something that the partnership will have to determine. Here is K1 for partnership. So the second tier, or the upper tier here, is a partnership. It's an affected owner, and it's an affected owner that with a taxable income calculated based on apportionment and allocation rules. Another example here is a C corporation. So a C corporation is not affected by PTET, and that C corporation is domestic corporation. It doesn't have to, it's not, it cannot elect to pay composite tax, and it's not subject to pass-through withholding. So the mineral royalty withholding here that is allocated to that owner has to be passed to this owner so that they can claim it on their return. Here it's different. This is a F, so this is a foreign corporation. It's not an affected owner, so no PTET. However, it elected to pay composite tax. So now we see composite tax, and we see no mineral royalty withholding. That means that the mineral royalty withholding was used to pay for the composite tax. Another foreign corporation, not affected by PTET. It's subject to pass-through withholding. And again, so we see the pass-through withholding here. And no mineral royalty withholding because it was used to pay for the or partially the pass-through withholding. Here is a non-resident trust. This non-resident trust is an affected owner, but it cannot be affected by the resident election. So PTET is going to be calculated for this affected owner, but based on their Montana source income calculated through with apportionment and allocation rules. And this is how page 2 is going to look like. So here we can better see the cascade of payment. We have a payment in 2023 of $1,000. That payment is going to be considered PTET regardless of what was put on the voucher in 2023. because this pass-through entity made an election. And here is the amount of taxable PTET. This is the amount of PTET that's calculated out of the all the K1s of affected owners. This is the amount of flow-through payments that is applied against the PTET, and that is an overpayment of PTET because we have 2,600 and then 1,000 here. That overpayment is now going to be used against composite tax, and then later on partially through against the pass-through withholding, and then there's a refund of $600. One word about this this amount of overpayment, because it's an overpayment that is essentially refunded here entirely to the pass-through entity. It is likely or almost sure that this is going to become income for the pass-through entity at one point, I mean, in 2024, because they deducted $1,000 in 2023 and received a refund of that amount in 2024, even though it was used to pay other taxes. So that's the tax benefit rules that everyone knows. If you deducted 1 year and receive a refund of that same amount the next year, then you have to recognize income. This is something that obviously already exists in other parts of the tax codes and tax returns. I just wanted to point that out here because this is going to be something that you need to take into account when making all your deduction calculations for a federal return. Now, a few words about how this pass-through entity tax will be applied on the owner's returns. So on the owner return, the PTET becomes a credit. It's a refundable credit. And estimated tax is required to be paid is reduced by the PTET payment. So when we calculate whether or not there's an underpayment of estimated tax on the owner's return, we're going to deduct the PTET from the amount of taxes owed first, so that we are not charging interest on underpayment of PTET that was already paid by the pass-through entity. Now, just a word for 2023. Some of the owners have already made large amount of estimated tax. Those estimated taxes paid by the owners will not be used as a credit at the pass-through entity level. So it is, if the pass-through entity wants to absolutely make payment in 2023, they may have to pay estimated tax partially twice at least, or it may overlap a little bit with their owner's estimated taxes. That's unfortunate, but there wasn't really no way to solve that problem. And lastly, credit for taxes paid to another state. So if you are a resident and you actually pay, if you're a resident, you actually pay PTET to another state, you can claim that payment as a credit for taxes paid to another state. Beware, however, that not all states have the same mechanism for PTET. There are basically three ways of dealing with PTET, like a purely pass-through entity tax, a pass-through entity tax giving rise to a credit, or a pass-through entity tax giving rise to a deduction. And even within those that allow you to get a credit, sometimes they don't allow you to take the full credit, but only up to your tax liability, and then there's a carryover. So this is quite complicated. And that's why in publication 4, we included some examples of how to deal with this situation with regard to the credit for taxes paid to another state. It doesn't pertain to the Montana PTET itself, but I think we thought it was important that you would have some guidance on that issue sooner than later, because this is becoming an issue and it's complicated. So that concludes my presentation. I think I have a few minutes to answer some questions.
Yeah, and we have quite a bit of questions. Great questions too. So I'm going to go through some of the ones that we already answered in the chat, and then we also have a few that I haven't answered yet, and we'll get to those as well. So first up, we had a question regarding. We've had a couple questions actually regarding excess payments by the PT. Well, excess payments by the PTE or excess payments made at the individual level. I'm wondering if you could kind of go into, an excess payment at the or at the pass-through level, and then also kind of talk about estimate, if the partner or shareholder has a little bit, has already made their estimated payments at their individual income tax level, how will that affect making the PTET election?
Okay, so let's talk about estimated tax payment. I think this is the question that is on everyone's mind right now. True, and anyway, it would have been true regardless, because this statute passed only at the end of the session this year, and it's effective this year. So owners had already made estimated payment by then. We are unable, to be honest, to apply any estimated payments at the owner's level against the PTET. So if the pass-through entity, if the owners have already made, let's say, their full estimated payment for 2023, assuming, and the pass-through entity in which they are an owner wants to actually make this election and take advantage of the pass-through entity tax for 2023, they will have to make additional payment at the pass-through entity level. The PTET is a pass-through entity tax, and that we can't use owners' payments in order to shift them around and assume that was a payment of PTET. It's legally very questionable, and it's technically impossible with the system we have right now. So it is what it is. Going forward, let's say for 2024, owners who know that the pass-through entity in which they have an interest wants to elect will want to reduce their estimated tax by the amount of expected PTET. So this is going to be something that they need to work with their tax preparers, CPAs, to find out what's reasonable amount of reduction of estimated tax in order to be risk-free. We included a few examples in publication 4 regarding how the mechanics works, but just to be very simple, really, the pass-through entity tax is a pass-through entity tax. Therefore, it needs to be paid by the pass-through entity for this to work, and the pass-through entity must make those estimated payments. Now, regarding the overpayment, like for any individual making overpayment, we're going to refund overpayment to the pass-through entity that recognize those overpayments. Now, if that pass-through entity has additional liability that is not PTET, we'll use that that money in order to pay that liability on the form. The form is designed for that, so that we don't send money to ask for some money back. But as far as the federal deduction is concerned, it's not because you use PTET excess payment to pay for other pass-through entity taxes like composite or pass-through withholding that you can still use this as a deduction. So as I said, the tax benefit rule will apply here at the level of where this overpayment is actually recognized on the return. There's a difference between PTET and composite tax and pass-through entity, pass-through withholding. Composite tax and pass-through withholding are taxes that are paid by the owners essentially out of their capital account. PTET is supposed to be a tax paid by the entity, and that's the only way you could receive a tax benefit for federal tax purposes. That is, if the entity pays the tax itself. I hope I answered all the questions here.
No, not really. So we've got about 3 minutes left, and we do have quite a bit of questions to get through. Would we be able to stay? Do you have time to stay on a little longer to answer some more of these questions?
Yeah, sure. Yes.
Okay, great. Next up, we did answer Matthew's question, but I don't know that we mentioned that the tax rate's actually going down in 2024. So the highest marginal rate in 2024 will be 5.9%. So just some clarification there. We had quite a bit of questions on the resident election. One of the questions was basically, how do you report this on the tax return? Do you report 100% of the non-Montana income to Montana?
Yeah, so remember on the, yes, so reporting the election is easy. It's just checking a box. And then there's a set of, especially if you file electronically, vendors have all the business rules that they need in order to calculate this, and it should populate almost automatically here at this point. At least that's the intention. On the Montana K1, you have two columns. You have a column for everywhere income and a column for Montana source income, but as we discussed, that column is really the Montana source income determined using apportionment and allocation rules. So if you are in a multi-state tax entity that has an everywhere column with all the income for that owner, and then the second column has only a portion of that income because that's the portion that is Montana source based on those apportionment and allocation rules. And if that owner is a resident, by electing the resident election, we're switching column. And maybe the best way is to go back to the example. I think case 1. Yes, so here we're switching column. So the PTET, instead of being calculated out of the column B here, is going to be calculated out of column A. And that's really, that's all there is to it, really. You just switch column. Yeah. Does it make sense?
I think so. Some other questions we have regarding the resident election. So you have to make the resident election for all residents that are that are on the our resident members or shareholders or partners of the past, correct?
Correct. For one word about the PTET election. This is an election made for all affected owners, not just a subset of those affected owners. And the same goes for the resident election. If you make the resident election, then all residents will be subject to PTET. obviously this is going to affect some owners more than others with regard to the federal deduction. But it's really well, first the statute was written in such a way that it doesn't allow for segregating each owner separately. So we went with what the statute said, but it also makes sense with regard to how much complication do we want to put into something that's already complicated. Having an election that applies to all resident affected owners makes things simpler. And if the resident owner doesn't get much of a tax benefit from that election, that means the PTET is not really high anyway, and they get that as a refundable credit. So it shouldn't be shouldn't affect them so much. Yeah.
We did get a question about sole proprietors, and I think I answered that, but just wanted to be clear with folks that it's only available to partnerships and S corporations. So your Schedule C filers, your Schedule E's, that filers that just have rental properties, and then your Schedule F farmers that or filers that don't have any partnership or S corporation aren't eligible to pay the PTET.
That is correct. Well, first, because it's an entity tax, and second, because Notice 2020-75 from the Treasury Department only pertains to partnership and S corporations, and that is the reason why the Montana statute only applies to partnership and S corporations. So it's really because the Treasury Department didn't contemplate that to apply to a sole proprietorship or Schedule F or Schedule C. No, yeah, I mean, only if this income were channeled through a partnership or an S corporation, then that benefit would be available.
Yeah. We did have a question on non-residents that are members of pass-through entities that are paying the PTET. Do they have to file a tax Form 2 or a FID 3 if they have any other source income?
Okay, it's an excellent question because I think I missed that a little bit. Yeah. No, if you are non-resident and you own interest in a partnership or an S corp, electing to pay PTET, more likely a partnership in this case, electing to pay PTET, and that's your only source of Montana source income, that like composite tax, you don't have to file a return. You can just keep your K1 and you're done. However, if you have another source of Montana source income, then you would have to file a return.
All right. Let's see, where did we go? Would you mind going back to slide 11? We had a question on deducting PTET on the Montana tax return. Actually, let's go back a little further. And maybe it's this right here. We had a question on where the deduction would be. And of course, and there's not a deduction for PTET. Of course, the election is made on the form, but the deduction is not made on the form. And in fact, it's an add back because you can't deduct state income taxes for Montana purposes.
Correct. I mean, I think we should return to how neutral it is for the state tax purposes. So the pass-through entity pays a state tax that allows that entity to take a deduction for federal tax purposes. So that deduction is embedded in the ordinary income of the pass-through entity. And but in order to make it neutral for Montana, it needs to be an add back. So the only way the way we're going to see that there was a deduction taken is by looking at the add back, and the add back has to match not only how much pass-through entity tax was paid to Montana, but pass-through entity tax that was paid to any state. So it can potentially be more than the pass-through entity tax paid to Montana. But yeah, that's how it's going to be reflected on the pass-through entity return, and then the owner get a refundable credit. I hope that answers the question.
All right. We had some questions about prior year overpayments coming in to the 2023 return from the 2022 return. Can you reclassify these payments? And then how would the deduction, the federal deduction, work for 2023, or when it gets converted?
That is an excellent question. I'm assuming, I mean, the feds don't really mind about their how we carry over payments. I'm assuming here, and this is my personal how I would do it personally. That so we are going to allow carryover payment to be used against PTET. So we said any type of payment. But that carryover, when is it supposed to be? When was it paid? Was it paid in the year it was effectively paid to the state, or is it something you could have been refunded and then pay again? I'm assuming, at least for the first year, that could be used as a payment, but only in the year you recognize it as PTET. That's what I would do it. But so in this case, that would be a deduction for 2024. But that, I mean, it's kind of an open question still, I think.
How about the refund? How would you treat the refund of excess?
So the refund of excess, that's more clear to me. I mean, it's the tax benefit rule really tells us that if it's an amount that was deducted in a prior tax year, so let's say you made an estimated tax in 2023, that's all the payments you made, and then you made an excess payment. So the PTET that you assess is less than the estimated tax that you paid. That difference is an excess PTET payment, so they're essentially refundable. And at that point, I think that becomes a income in 2024. Now, if you carry it over, if you carry it over, it's the equivalent. I mean, it's a step transaction essentially. You could have had a refund and pay again. So then that would become a 2024 payment. That's an excellent question. I'm assuming that that's how the feds would treat it. Like if you carry it over from 2024 to 2025, then it becomes a 2024 payment. But there's no certainty here.
We got an interesting question about an S corporation making the PTET election that pays all of the shareholders individual tax. Can you do no withholding on their wages during the year?
I'm sorry, I don't understand that question.
I believe it's more of like an S corporation shareholder. The PTET pretty much covers their entire liability for their S corporation income. Do you have to pay tax do you have to pay wage withholding on that shareholder?
Yes, so I think I understand the question. Estimated, so there's a wage withholding depends on how much estimated tax that shareholder has paid themselves for individual income tax purposes. PTET is assessed on the income derived by the pass-through entity, so after the deduction of wages. So if the shareholder deducts wages, then PTET will be assessed on the net amount of income, net of wages. So yes, there essentially the S corporation still has to pay wage withholding, but that amount really is a matter of how much the shareholder will have paid, how much estimated tax the shareholder will have paid, not so much, or not at all actually, how much estimated tax the pass-through entity will pay. I understand that there's communication between all those three. So this is something that will have to be carefully looked at by the preparer. But technically, the answer is that wage withholding doesn't depend directly on the amount of estimated tax the pass-through entity or the S corporation pays for PTET purposes.
I've got a question about making the election with the payment. So maybe you could talk a little bit more about the timing of the election and then when the payments are actually made in relationship to the election.
Okay, so if any payment is made in 2023, even if you didn't think that you would elect to pay PTET, and then you elect to pay PTET on the 2023 return, all those payments made will be assumed to be PTET payment first. So that solves the problem of, hey, I didn't intend to make that election in August, but then I thought that would be a good idea in December. And how do I treat my August payment? Well, my August payment will be also a PTET payment to the extent that the election is made on the return. Now, the timing of other types of payment is more tricky. So if you make a payment of PTET with the return, obviously that's going to be in 2024, and therefore that cannot be a deduction for the 2023 return. That will be a deduction for the 2024 federal return. For the flow-through payment, and that's where things become difficult, and maybe the CPAs will have to, if they want to apply some of those payments to 2023, look at those things more carefully. But assuming that they really don't know, because most of the time you don't have that information with the 1099 or Montana K1, when this mineral royalty withholding or the pass-through withholding or even the PTET credit was actually paid, then they would have to assume that it's a payment made in the year the return was filed. I think that would be the safe bet here. Yeah, unless they receive an information to the contrary from the payor saying no, that was paid in 2023. So it's likely that mineral royalty withholding showing up on the 2023 return are actually paid in 2024. It is also likely that, for PTET and pass-through withholding, it's a toss, really. It really depends. But to the extent that the partnership or the S-Corp doesn't have this information, they'll have to assume that it was paid in 2024.
Okay. We had a couple questions on how to make the estimated payment. You can log into TAP, and if the taxpayer does not have a TAP account, you can just log in using their FEIN And then when you go to make the payment, you'll just select the entity type, so partnership or S Corp, S corporation, to make the payment. Do you want to add any more to that, David?
Yeah, you already had, I think, some option. I think tentative payment or estimated tax. Again, it doesn't really matter because all payment, if you elect to pay the pass-through entity tax on the return, all payment you would have made in 2023 will be regarded as PTET payment.
All right. We did have a question on how the PTET works as a federal deduction.
Mhm.
And I'm assuming that maybe in relationship to where it's located on the taxpayer's federal tax return, as well as maybe the timing.
Okay, so yes, the deduction is a federal deduction, so it will be included on the 1065 or 1120S, where you usually put your any tax that you can deduct under 164. So it's not just state income tax; it can be also state property tax. It can be also personal property taxes. All those taxes that you recognize, the deduction of which you recognize on the 1065 and 1120S. That's where it's going to be. Now, what was the second part of the question? The timing of it?
Yes.
The timing is really most partnership and S corporation on cash basis, so they can take that deduction there only in the tax year they are reporting for. So only if you made some payment in 2023 will you be able to take the deduction. So let's think about this for a second. You make an estimated tax payment in 2023 that and then you make that election on the form PTE that allows you to deduct from the partnership's return that entire estimated payment for 2023. Now, if you made an excess payment and you're refunded or the excess payment because the assessment of PTET was less, well, then in 2024, you're going to have to recognize income, but you're going to also make probably another estimated tax payment of PTET to get that benefit for 2024. So that recognition of income and that payment of estimated tax will offset each other, and the net amount will be the new deduction that you'll take for 2024, and so on and so forth. So it's not really different than how actually the deduction for making estimated tax on the individual return works currently for federal tax purposes. If you make payment within the $10,000 range and then you get a refund, then you have to recognize income the next year. It's kind of the same mechanism.
Okay, we got a couple questions about the PUB4. That should be available later this week or early next week. And we'll be sending out a tax news you can use, so our newsletter. So if you're not signed up, I encourage you to go out to our website and sign up, and I can put in the chat the link to sign up for our tax news you can use newsletter, so you can be in the know when that hits our website. All right, quick question on here. Who's the PTE representative? Is it the owner signing the return? I would say that's anybody the pass-through entity designates, right?
That's correct. Yeah. I mean, obviously, it's better to have, maybe it makes sense to have a general partner or the managing member of an LLC or that person making that election. But we give, the partnership or the S corporation has to designate someone, and they should do it in the way they feel is the best. For them, the purpose of this, I guess, is that we don't have to deal with owners separately. We only have one person to which we talk to in case there's a problem with that PTET election. Now, there shouldn't be a lot of problem. It's an election. It's a voluntary compliance, if you wish. So we don't anticipate a lot of difficulties here, if any at all. But it's a good idea to have that representative included in the return. And technically, the election is not valid if you don't give a name for a representative anyway.
Okay. All right. If the PTET is owed with the tax return, the entity, can they pay it with a payment voucher, or do they need to pay it using TAP?
Either way, I think. No?
Yeah.
Yeah.
And then, so we've got about, we're going to cut this off in about 8 minutes here. I'm going to try and hit some fairly easy questions here. One question was if the attendees could get copies of the slides.
Yes, we can make this available. This is a presentation we made already, and it summarizes what's going to be in publication 4. So yeah, we can make that available.
Okay. Let me see. I do have I have a couple hands raised, and I know Tracy, you've had your hand raised for quite a bit. So I'm going to ask Jason if he can open you up.
All right. So if somebody has their hand raised, I have to ask them to unmute. So Julie, you are unmuted right now. Julie, you have to unmute yourself. I can't unmute you, but I can't ask you to unmute. And so I asked you to unmute. And she may have stepped away. So if there's something in the chat that you want to do.
Yeah, so we had a couple comments about eliminating the SALT limitation. You know, I don't know, David, if you want to talk about this, but yeah, as practitioners, you might want to just keep that in mind. Of course, Tax Cuts and Jobs Act is set to expire in 2026, so that's something to keep in mind. So it may not be useful coming down the road, but who the heck knows with the federal government what their plans are and what they plan to do. I have heard from some practitioners that it would be helpful for AMT purposes, to keep using the SALT. So that's something that I have heard out in the preparer world.
Yeah, and this is, I mean, we don't know the secrets of Congress, so they have their own way to balance their budget or unbalance it, depending on how you see it. But anyway, what we've seen a lot of tax provisions that were set to expire that never did. So far it is, but I mean, this is something we can answer only probably in 2020, at the end of 2024.
Okay. Let's see. So talking more about who actually will benefit from the PTET election.
So owners that are limited to $10,000 in their state property tax deduction on their Schedule A, there might be a subset of owners that are actually not itemizing that could benefit from it. I'm not sure how large that subset of owners is, but more likely the owners that have a limitation on their state income and property tax deduction. So if you have an owner that has already paying $10,000 or more dollars of property taxes, then that election is really a no-brainer. Uh, if if they are
What if they're an
not,
investment partnership?
sorry.
What about if they're an investment partnership? Would that be useful or not useful to make the election?
Yeah, I believe so. Even past and even publicly traded partnership, I suppose, that can benefit a lot of people, even if it's an investment partnership. Yes, which is not something. Just going, make a side comment here. There's no such a thing as an investment partnership recognized per se in the Montana statute, but I'm assuming that what we're talking about are partnerships that are just invested in interest, stock, and so on and so forth.
Okay. So we have 3 minutes left. I'm gonna I'll go here from the top. We just had another resident election. So making the resident election, that doesn't make non-residents make the resident election, right? The residents
Correct.
are on 100% of their income, which is of course taxed 100% in Montana, while the non-residents are just on their Montana distributive share amount.
Right. Yes.
And then the federal deduction for PTET is the amount paid, not the amount of PTET calculated on the Montana return. So if PTET was actually $4,500, but the PTE paid $5,000 in estimated payments, the deduction for federal would be $5,000, not $4,500, right?
That's correct.
Okay. All right. Moving on here. While it might be beneficial to residents to get a state income tax deduction, seems we should be careful as to how the allocation of PTET affects owners' capital accounts and or Section 704B allocations. Under the resident election, will non-residents be charged their pro rata share of PTET and then allocated to the resident members, or should the PTET be treated as a draw? That's a good question.
Yeah, I think the question is how does it affect the capital account of each owners? I think the position of AICPA is that that the capital account is reduced by the amount of PTET that is allocable to each owner separately. And in this sense, at the end of the day, it's not going to make a huge difference if you compare it to pass-through withholding. I don't think it makes much of a difference. The real difference is that it's paid by the pass-through entity, and it's kind of like it has to meet the standard that allows us to say that it's a pass-through entity tax. And this standard is described in 2020-75.
Okay. Well, we're at 12:30, so we're going to cut it off. I would say sign up for our newsletter if you're not already signed up. We'll be releasing our publication 4 later this week or early next week, and hopefully some of your questions will be answered there. It's definitely a tough topic, and I think there's a lot of tax planning opportunities for practitioners out there to think about. As we've all seen, you guys had some great questions that even got us thinking as far as, more things to address, but also, things that you guys could probably use in your tax planning with your clients. So we thank you for attending. We've got 3 other webinars upcoming in the next 3 weeks. You can check out our website for that. And then if you'd like, you can also go out on our website and review the recording if you want to go back and look at it some more. So with that, thank you from me, Rachel. And David, I'll let you as well say your thank yous.
Well, thank you, everyone. And yes, this is a tough topic. Do make sure that you catch publication 4. I think it will clarify a lot of the questions that we received today, and cement the knowledge on the pass-through entity tax. And do not hesitate to contact the department when the time comes to complete the return if you have any questions. Thank you.
All right. Thank you, everybody. And we'll wrap this up. Please look at our website. You can watch this presentation again, or you can send it to somebody who maybe didn't watch it the first time. So it'll be out there. Thank you so much. We do have more presentations that are coming. So just make sure that you're watching those, because you don't want to miss out on that as well. So I'll end this presentation. You folks have a nice Monday, and we will see you later. Thank you.